us work a bank reconciliation problem. We're going to do problem 4-47A, and that's on page 193 of your textbook. Again, that's problem 4-47A on page 193 of your textbook. And I have it on the screen as well. On May 31st, Sharp Company had a cash balance in its general ledger of $6,675. So when it says a cash balance in its general ledger, that is in its accounting records, in its books and records. So we could take that information, and I've started the worksheet down here. We have one column for the balance per the bank statement, and then another column for the balance per the books. And our initial book balance is $6,675. So we have that started. The next sentence says, the company's bank statement from National Bank showed a May 31st balance of $8,240. So that $8,240 will be the first line of our balance per book, and I have that down here. And then it gives us 5 facts that we have to take into consideration when we do our bank reconciliation. You can refer back to my lecture notes or to your textbook on page 156 through 158. Okay, Part A, Sharp's May 31st deposit of $1,000 was not included on the bank statement because it was dropped in the night depository after bank hours on May 31st. So the company, Sharp Company, made a deposit on May 31st, but the bank did not get it, and it was not reflected on the bank statement because it was still in the night depository box, the night drop box. So that deposit in transit, that deposit will already be reflected on our books and records, because when our accountant or bookkeeper wrote out the deposit slip to make that deposit in the bank, she would have updated our books and records. But the bank did not have it reflected on their records, so that we need to adjust the balance per bank. We're going to add, and that's called deposits in transit. And it will be plus $1,000. Okay. And then Part B, the bank's general service charge for the month was $100. The bank's service charge. So that would have been reflected on our bank statement. The bank knew about that, but we had not adjusted our books for that. So it's not going to be in our book balance. We're going to have to subtract that out. Service charge. Okay. Now, Part C. The bank collected a note receivable of $1,500 for Sharp Company, along with an additional $58 for interest. So we had made somebody a loan. We had loaned somebody money. So we have a note receivable on our books. This tells us that the bank collected that for us. So whoever owed us money from this loan, instead of writing us a check for $1,500 and then another check for $58 for the interest, they paid the bank. But they paid the bank the part that should go to us. So the bank would already have that reflected on the bank statement, but we need to adjust the book balance. So we have note collected by bank, and you could put note collected and interest by bank. Note, well, actually I'm going to put note and interest collected by bank. They owed it to us, but they paid our bank instead. And sometimes you may see this, this may be common between transactions between companies. And then I've also heard some of my students have mentioned before, like their landscaping company. They know who their landscaper is, so they just send money to their landscaper's bank account on a monthly basis or a weekly basis or whatever, they don't actually write a check to the landscaper. So that would be another situation. If if our company already knew that this was deposited in the bank account, then it would, if we had already updated our records, it would already have been in this amount. But if we didn't learn about it until we got the bank statement, then that's when we would need to add this in, if we had not already adjusted our books and records. And actually, they had collected $1,500 and then plus $58 for interest. So they actually had an addition, that should be plus $1,558. Okay. Now the bank deducted a $30 fee for this collection service. So that would already have been reflected on our bank statement. So in the bank balance, they already deducted that $30. It's already deducted from that. So we don't have to deduct it again, but we do need to deduct it from our book balance. And you can call that bank collection fee, or charge, something along those lines. That's $30, so we're going to subtract that from our amount. And then the next sentence there says, Sharp Company had not accrued any interest on the note. So that's going to tell us when we go to make our adjusting entries, we're going to have to reflect that as interest revenue now, because we had not accrued any interest. We had not recorded any interest revenue up to this point. So we'll have to do that when we go to make our adjusting entries, and we'll talk about that in just a second. Now, Part D, Sharp's bookkeeper erroneously recorded a payment to Williams Company for $192, but she recorded it as $129. The check cleared the bank for the correct amount of $192. Okay, I think these are the most difficult parts of the bank reconciliation to me, so you have to be very careful when that's an error. I think first you should ask yourself, who made the mistake? Did the bank make a mistake, or did your bookkeeper or your accountant? Here, our bookkeeper made the mistake, so we're going to make the adjustment over here. And errors can go either way. Sometimes you would need to add something, sometimes you would need to subtract an amount. You just have to read the fact situation to see whether you should add or subtract. So here our adjustment's going to be on this side because our bookkeeper is the one that made the mistake. The check cleared the bank in the correct amount, so the bank statement would be right. It's our books and records that are wrong. So we made a payment of $192. So our bookkeeper wrote a check for $192, but when she keyed it into our accounting system, she only keyed it in as $129. So our accounting system shows that we only paid $129, when in reality we paid $192. So we need to reduce the difference because we actually paid more than what our accounting records are going to show. So we have to fix that mistake. So an error, bookkeeping error. And the difference is $63. So you're going to subtract that $63. Okay, one more adjustment to make. Sharp's outstanding checks at May 31st totaled $1,200. So outstanding checks, that means we have written checks to either our vendors or maybe to our employees, and they have not cashed those checks yet. They hadn't taken them to the bank yet. So our bank does not know about those checks. Ooh, my computer just messed up. Let me enlarge the screen. So since those checks have not cleared the bank yet, our bank does not know about those checks. We wrote the checks, or our bookkeeper wrote the checks. So when she wrote those checks to whoever they're for, most likely to our vendors or to our employees, she would have recorded them in our accounting system. So they would have already been reflected in this amount. Okay, that's important to know. They're not reflected in the bank's balance because at the time of the bank statement, they had not cleared the bank yet. So the bank did not know about them and still probably doesn't know about them. So we need to go in here and we're going to subtract out outstanding checks. My lines are messed up, but hopefully you can. We're going to subtract $1,200. Okay. So these columns are a little messed up, but you can get the idea. Hopefully yours will be neater. So now we're ready. That was our last adjustment. So now we're ready to subtotal these amounts. Okay. So just add and subtract. This is going to be called our true cash balance. And let's see. Take $8,240, add $1,000 deposits in transit, and then subtract 1,200 outstanding checks, and you're going to get a true cash balance of $8,040. Now it's time to check ourselves and see if this side, remember both sides should equal. So start with your initial book balance here, 6,675. Subtract out that service charge of $100. Add in the note and interest that the bank collected on your behalf. And then also subtract the collection fee of $30 and subtract that error of $63. And that's going to give you a true cash balance of $8,040. So these numbers need to match. Sometimes the problems in real life, you will have, you can compare these two columns, but sometimes the problems for the homework will just give you enough information to do one or the other. So it will just give you enough information to do either the balance per books or the balance per bank, and that's fine. It's just trying to make it a little easier for you. But if you have enough information, you should do both and then compare them and make sure that this number equals this number. Now, if you are preparing your balance sheet on May 31st, notice that the dates were May 31st. Everything was May 31st. We were trying to find the true cash balance on May 31st. So on our balance sheet for May 31st, we would use this $8,040 as our cash amount. We would not use the initial amount that was on the bank statement, nor would we use our amount per our books before we made these adjustments. We would use this amount. This was our true cash balance on that date. Okay, the second part of the problem asks us to prepare the necessary adjustments in the accounting equation to update the records of Sharp Company. So if any of these adjustments are not already recorded in our accounting system, we would need to make adjustments so that our accounting system is updated. Keep in mind that this worksheet is not part of the accounting system. This is just a bank reconciliation worksheet. So it does not update your accounting records. If you need to update your accounting records, you've got to put it into your accounting equation. Okay. So everything on this side, this bank side, we have two adjustments. We have the deposits in transit and the outstanding checks. Both of those items have already been recorded in our accounting system. So we are not going to have to record any of those in our accounting equation. But everything on this side, this balance per book side, all of these items, the service charge, the note collected, the bank collection fee, and the bookkeeping error, we're going to have to go and record those adjustments in our accounting equation. So let's do that. And I have the accounting equation here. Remember on the first day of class I said memorize this because we have to use it. We'll use it every class until the very end of the semester. So let's start with A. A was dealing with the deposits in transit. We don't have to make any adjustments for that because that was already in our accounting records. When we filled out that deposit slip, our accountant had already updated our accounting equation for that. Now B is dealing with the service charge of $100. So the bank is charging us $100 to have a checking account there. So we don't actually write the bank a check or give them $100 cash. They deduct that amount from our bank account on a monthly basis, but it's still an expense. So we have to record it as a bank. You can call it a bank fee or a bank service expense or a bank service charge. Any of that terminology would be okay, but it is an expense, so it's going to show up. This is going to show up on our income statement, and it's also in the retained earnings column. Okay, so now our accounting system is updated for that charge. Let's go to C, part C. The bank collected a note receivable on our behalf. So we have cash coming in of $1,500, and that would reduce our note receivable. We know we had a note receivable because the problem told us, and now that person is paying us off. Notes receivable are very similar to accounts receivable. So an accounts receivable is when we have sold something on credit and our customers have not paid us yet. So when they do pay us, we have positive cash coming in, and then we have to reduce that accounts receivable. This is very similar to that, except for a note receivable. That means we have, instead of selling something on credit, we loaned someone money. We have loaned. The company has made the loan to someone. So they owe us, and here they're paying some of that off, or they may be paying the whole loan off. We don't know what the full amount of the loan is, but we do know that they paid $1,500. So we're going to reduce their note receivable for that $1,500. Okay, and then that's balance. So now we have to deal with that interest. They paid us $58 of interest, so that's cash. And let's go back and look at what that says up here. It says the Sharp company had not accrued any interest on the note. So that lets us know that they had not already recorded interest revenue and interest receivable. If they had, we would just reduce our interest receivable. But since it says they had not accrued any interest yet, we have to record it as interest revenue. We want that interest revenue to show up on our income statement. Okay. Now, in that same portion in Part C, it also tells us that the bank charged us a $30 fee. The bank charged us for collecting this on behalf of our company. So we're going to have a $30 reduction in cash where we pay this fee. And again, it's going to be a bank fee, or you can say bank collection fee, something along those lines. If you want to use the word expense, that's fine. You can say banking expense. Now we just have one more adjustment to make in our accounting equation. Part D, where the bookkeeper made an error. Let's go and read that. The bookkeeper erroneously recorded a payment to Williams Company for $192. So we owed Williams Company $192. We wrote them a check for $192, and it cleared the bank in the correct amount of $192. But when our accountant, she wrote the check out correctly, but when she went and made the adjustment in our accounting equation, she recorded it as $129. She had a keying error. So now we have to go in. So when she previously did it, she recorded cash going out of $192 when we really had cash going out of $192. So we need to go back and reduce our cash by the difference, $63 cash. And we have to have our accounting entry balanced. So we have to have something that will balance this. Since we made this payment to another company, it's probably a vendor, somebody that we buy our inventory from. So it's probably an accounts payable. We owed that company, so that was reflected in an accounts payable originally. So we need to go back and balance our equation with an accounts payable. 63 accounts payable. So that should be all correct now. Now, when you have a bookkeeping error, it may not always be an accounts payable adjustment. You would just have to read the fact scenario and see what would fit the situation. For instance, here we paid another company, so it's most likely an accounts payable. But for instance, what if the scenario had told us that we had written a check for $192 to pay for office supplies, and we immediately used all of those office supplies immediately. And the bookkeeper had written the check for $192, but she had entered it into our accounting equation as $129. Well, in that situation, we would not have an accounts payable adjustment. We would still have the cash, the negative $63 cash, but the part that would balance the equation would be here as a supplies expense, because we didn't write the check to another company. We used it to buy supplies, and she had just and we used those supplies up immediately, so it's immediately expensed. And that's just another situation that I could think of. So anytime you have an error by the bookkeeper and you need to make an adjusting entry in your accounting equation, you just need to pay attention to the fact scenario. If it's to another company, go ahead and adjust the accounts payable, but just read the facts closely. Now, the last part, E, Sharp's outstanding checks at May 31st totaled $1,200. Well, those outstanding checks, we wrote those checks. The bank doesn't know about those checks, but we do because we wrote them. So at the time we wrote the checks, the accountant would have already entered them into the accounting equation. So we don't need to enter them again. So now that completes this problem. You're going to do several bank reconciliation problems for homework.